Welcome back. In the last lesson, I talked about streams and chunks of money going out for expenses and goals. And I also talked about streams of money coming in and your piles of money, which you have already documented. So we're going to pull all that together into a buckets strategy to illustrate how you might manage money overall, the general strategy for retirement using the buckets concept. There are 3 buckets involved, and I'll get into more detail in a moment, but I'm just going to tell you first. The cash bucket, which is where your income will come in and spending will go out, and it will have your emergency fund and a cushion. Then there will be a bonds and CDs bucket, which will be supporting your spending needs that are 2 to 5 years out. And then there will be a stocks bucket, which will be the bucket, remember, helping you stay ahead of inflation. And now I'm going to illustrate how all that works. I'm not an animator, but I have done my own drawing here. So let's talk about the cash bucket first on this side. So the cash bucket, you can see you have streams of income coming in. And in the beginning of retirement, that might not be Social Security yet. You might not have a pension. So it might be actual principal withdrawals from a taxable account, or it might be some withdrawals from your IRA, provided that you have figured out that that is sufficient to bridge you until you begin to get a stream of income from Social Security or pension later. That is a little more detail than we can do in this course, but I did provide a worksheet to help you get started on that. Then at the bottom you can see of the bucket there's the money going out for your expenses. So if the level in the cash bucket starts here at retirement, if you have a shortfall, which most people will, between your ongoing source of income and the money going out, then you will the water will begin, the level of your cash will begin to shrink. And it will begin to shrink to what I call the yikes level. And everybody has a different level of yikes, where the cash just gets low and you think, yikes, I don't know if I have enough cash. So that's the yikes level. You might want to think about what that level is for you, just when your bank account or your total cash gets down to a certain level. But how much should you start with? My suggestion is to start with 1 to 2 years of the difference or the shortfall that I just described. So that means once you do begin taking Social Security or your retirement withdrawals, you won't need to keep 1 to 2 years worth of the shortfall in cash. You might keep 6 months to a year's worth of living expenses in cash. Okay. Now the remainder gets split between bonds and stocks. And remember also from our food groups lesson that the proportion that you have in bonds and stocks and the different asset classes or food groups in there is a huge determinant of your long-term success. So figuring that out is a very important part of the equation. As a general rule, if when you did your worksheet you found that more than 70% was in stocks and you are within 5 years of retirement, I would suggest you consider reducing the stocks bucket and begin to put more in the bonds and CDs bucket. Okay, so now how do the bonds and stocks support your lifestyle logistically? So what I've got illustrated here is something called a bond or CD ladder. You can do this with actual individual bonds, although I suggest you get a professional manager if you do individual bonds. Don't do them yourself. Or you could do it with CDs, or you could do it with bond funds who have approximate maturity dates in these different years. So you would do what's called a ladder and have these bonds and CDs maturing in chunks in certain years in the future, or even in 6-month increments in the future. And what will happen is, as those maturities happen, that money will flow over to the cash side. And it will replenish once you get to this yikes level here. So the bonds and CDs are generally for 2 to 5 years out, depending on how your allocation goes between the bonds and the stocks. Now, what's going on over in this stocks bucket? Well, as you know from your experience watching the stock market, the water's all sloshing around in here. It's going up and down a lot more than it is in the bonds and the cash buckets. And so how do we handle that? Well, if the black line is the original amount, your principal or cost basis that you've put into the stocks, and the little black ticks down here are the regular intervals at which you are doing something called rebalancing, which means you are going in and looking at the stock value. You're going to go in at these intervals and you're going to say, do I have a gain here? Oh, look, I have a gain. I can take the gain, maybe not sell the entire amount of the stock or fund that you have the gain in, and transfer it to the bond bucket. So then now it gets added to the ladder at the end, or it just gets added into some kind of higher yielding investment that is safer than stocks. And if you go in during retirement and you're in the middle of a recession in the market has crashed, well, then you just leave things alone. And you can afford to do that because you have this whole cushion here with your bonds and CDs, and you have 1 to 2 years worth of cash here. So this is the way in retirement that we handle fluctuations in the stock market and not let it get to us, because we have plenty in bonds and CDs and plenty in cash to satisfy our spending needs. The other thing that this strategy does is keep us away from the question of, well, what percent can I or should I be withdrawing every year from my portfolio? There's much debate over whether the safe withdrawal rate is 3%, 4%, 5%. It doesn't matter when you have these bucket strategies in place, because you are just taking advantage of the gains in stocks and not worrying about taking money out of stocks in a down market. I hope this bucket strategy makes sense for you, because the next step is to apply this to the different account types that you have. So whether you want the cash, of course, to be in the taxable account and tax deferred accounts where you're about to take distributions. Bonds and stocks might be different in different account types. That's going to produce a matrix of possibilities that we're going to go over in the next lesson. So please post your comments, questions, or feedback in the discussion area.